Hi, this is Drew Tignanelli. It's the beginning of the third quarter, and this is our video update. As you can see, Timothy is not with me today. He's on a well-deserved vacation, and I think he'll be back. I'm not sure when he'll be back, to tell you the truth. He may be in Wednesday, but then he's off again on Friday. But you know, while he's not here, we might as well just tell you a little bit about some of the things that he's been doing. I can't express how significant an impact he's having on the industry in the last 4 years. So 4 years ago, I said to him, Tim, you're really a communicator. You need to go out and you need to start communicating. You need to start making national contacts and get out there with your enthusiasm and communicate what professional financial advising is all about. And in that 4 years, it's amazing what he's done. He's written 2 books with Jim Stovall on financial planning. He's well received by CNBC, constantly asking him to come up and do interviews. He's been on NPR numerous times, the Diane Rehm Show, the Morning Edition. He's been in many of the publications. Kiplinger calls him often, Money Magazine. You know, he writes blogs. He did this, a couple of them lately that have been reviewed over 100,000 times. And he's really making an impact. And at such a young age, it's just very impressive as to what he's done in the last 4 years. And I just wanted to honor him for that. You know, we joke and tease sometimes, but there are times that we just need to sit back and be honest and let everybody know how pleased we are with what he's done over the 4 years that he's been with the consulate. But you're watching this video because you want to know also what's happening in the marketplace. June was an interesting period of time. It was kind of a brief 2008 hiccup. What do I mean by that? Well, if you analyze markets over time, it's rare that you will ever see every investment going down at the same time. Or in other words, there's always some markets that are going down and some markets that are going up. But in the month of June, you had bonds going down, you had stocks going down, you had gold going down, you had international markets were going down. There was pretty much nowhere to hide in the month of June. And actually, what's interesting about that is it was unique in the regards to 2008, because in 2008 the U.S. Treasury bond market went up, everything else went down. All other bonds went down. Municipal bonds went down, corporate bonds went down, markets went down, gold went down, international markets went down. Only U.S. Treasury bonds went up in 2008. This time, U.S. Treasury bonds went down, stocks went down, gold went down, and corporate bonds went down, municipal bonds went, you name it, it was down in the month of June. It was a fascinating month. Fortunately, it was short-lived, but I believe it's a foreshadowing of what may come in the future. Now, when I say the future, I'm not talking about tomorrow. I'm not talking about a week from now or a month from now or a year from now. I don't know. But I think that probably no more than 3 years from now, we're going to see another major hiccup that might be even more interesting than 2008, because it will bring a decline even in the Treasury bond market. And the reason that this is true, in my opinion, is because the Federal Reserve has so greatly manipulated the Treasury market over the last 6 years that it causes serious distortions. If you watch how markets operate on the risk-free rate of return. In other words, if you tell me that the 30-day or the 90-day U.S. Treasury bill is yielding 5%, 2%, 1%, whatever it might be, investors will say, if that's what I can get with no risk whatsoever, then I'm going to try to get 3% more, or 5% more, or 2% more, or 8% more by taking risk. Well, if you manipulate the risk-free rate of return down to zero, basically 1.1%, 0.05%, which is the 90-day Treasury bill, if you manipulate that down to zero, then people are making investment decisions today, and it's exactly what Bernanke has said that he wanted to do. Investment decisions today are being manipulated by the activity of the Fed because they're saying the risk-free rate of return is this, therefore I can't afford to live off of that, I'm going to go try to take some risk. Well, the point is that when this unwinds, all of a sudden everyone's going to have to rethink how they've invested. And that's why I think what June was a foreshadowing of what might happen in the future. But with that said, you also have to understand that we're in a conundrum. The conundrum is this, that the economy is improving to some degree, but it's not perfect in any way, shape, or form. And so the market is going to say, okay, look, interest rates are still down to this level. The economy is improving, so markets are going to go up, and markets are going to have that fear that the Fed is going to take the punch bowl away, as we like to say. Well, anyway, here's the other thing that we have to think about is lately you had this amazing movement in the Chinese market. It went from 1900 to about 2600, and it's come right back down to about 1900. Now, what's fascinating about that is that the Chinese market is currently down 70% from its all-time high, and it's only 5 to 10% from its bottom in 2009. The Chinese market is selling for a 30% discount to the U.S. markets, and but yet China's growing. Even if they have their crash landing that everybody's talking about, they drop down to a 3% growth level. That's their idea of a crash landing. We are growing at 1 to 2% if we're lucky, and yet our markets sell for 30% more than the Chinese market. And so the Chinese market has had a lot of volatility. I think we're going to continue to see volatility, but the growth opportunity is tremendous. There are issues that have to be resolved, absolutely, but there's issues in the United States that have to be resolved. We haven't even begun to see the implementation of the Affordable Care Act. And that's starting to, the businesses are starting to feel the bite of that. Anyway, the point is that you have to be cautious. You cannot just throw abandon to the wind. Is that the word? Did I say that one right, Ben? You remember last time we talked about how I do these, and I mix them up sometime. We can't throw caution to the wind. That's the one. There it is. Anyway, so we have to be careful. Real quick on a financial planning topic, college planning. Number one, make sure that you don't bankrupt yourself sending your kids to expensive colleges thinking you're doing your child a great favor, because statistics are saying that, whether a child goes to a inexpensive school or a very expensive school, as long as they graduate from with an undergraduate degree, and they take that and do something more, like get a CPA or a lawyer or a doctor or a master's degree or something else. Those are the things that give people opportunity. College, undergraduate degree in college is almost like high school. Like graduating high school back in the 1960s is the equivalent of graduating from undergraduate degree in college today. But the other thing that we want to talk about is you need to teach your child about money management. And the key is that when they're in high school or senior in high school and on through their freshman and sophomore years, you have to let them know that you have to work, and it's important that children work and earn a paycheck, even if it's something they don't like to do. They have to learn how to pay bills. You give them a credit card, but you let them pay the credit card bill. Even if you give them the money, make them write the check. Make them think about you know, that you just don't use this piece of plastic and have no consequences to it at the end of the day. It's very important that you get them to understand that you have so much cash, and that cash is not unlimited, and that there's not a genie on the other side of college that's going to just keep giving you money if you need it after you graduate from college. You know, because those genies that are called credit cards and things like that, they ultimately come back to bite you. You also have to make sure that your student does not borrow a lot of money based on the degree, even if they're going to make a lot of money. You know, I see people graduating, going to medical school, and walking away with $200,000–300,000 of student loan debt. Even though they're going to make a lot of money, that's a lot of money to pay back. You know, but even worse, I see people graduating with $100,000 of student loan debt and making $20,000, $30,000, $40,000. That's even worse. Neither is good. Debt is an instrument that should be used wisely. And if you're going to take on debt, it should be no more than 1 times the amount of salary you think you're going to make at the end of college. Anyway, with those tips about how to train your child into money management and our word of caution, you know, a conundrum. You got good things going. You can make money in these markets, but you have to use great caution, because when these markets pull back, as we saw in June, they're going to pull back, and they're going to pull back hard. With that, I'll just end it for this third quarter update.